at another show of Reinventing Finance. Tom and I are super happy to have been able to convince Florian to join us on our show. Florian, welcome. How are you?
Hi, nice to see you again. And by the way, thanks a lot for having me today. Quite happy to be with you. Sunny day, perfect roundtable. So looking forward to the discussion.
I mean, how great is that? Sunny day and all of us, indoors on our webcams. Great. Life can go on. Florian, why don't you briefly, for the very few that might not know you out of Tom's and my respective network, who are you, what's your background, and what cool things have you guys cooking up with Astorya?
Yeah, so basically, my name is Florian. I'm 36. I've been working in the investment space for close to 15 years now, investing in tech startup at seed stage since inception. And actually, I've been navigating the insurtech scene almost since inception as well, let's say around 2014, because I was at AXA Ventures back then. And for a few years now, I'm running my own VC firm, astorya.vc. And long story short, we raised money from insurance companies to invest in insurtech across Europe. That's our scope. By the way, mentioning that we are investing at seed stage, obviously that's what we know how to do. And that's where I believe there are the most exciting opportunities right now in the insurtech scene. So quite excited about what might happen, especially as the pace of innovation is accelerating right now in that ecosystem.
So I think that's really interesting. I guess two questions just for how would you define seed? Maybe by ticket size, valuation, revenue, because it seems to be a pretty slippery term.
Yes, you're perfectly right. I believe that we all have our own definition of seed. So our definition at Astorya is post-product. So the company needs to have a product. The rationale is that we invest a lot in B2B technologies, and we believe that we have a very strong network among insurance companies across Europe. So one way we try to accelerate the growth of our portfolio companies is accelerating the sales process by connecting to the right people in our network. So having the product available and ready to be sold, that's a requirement, meaning that we don't necessarily have any requirement in terms of revenues. But obviously, the closer you are to our scope and our network, the more flexible we could be on this revenue part. And maybe to define it with a few figures, we usually take part, let's say, of rounds below 2 million euros. I would even say 1 million euros most of the time. So we usually invest with business angels, and that's a way for us to be in startup before anybody else, and creating a bit more values, because I think that we will mention that later on in the discussion, but the European market is not a huge market in terms of exit. So the cheaper we enter, the more return we can deliver to our investors.
And do you have a specific thesis on the insurance market, and have you backed up all of those? Have you managed to back up all of those theses yet?
No, not yet. That's why we are building right now Astorya VC2 to keep investing and accelerate a bit the pace of investment. But long story short, our punchline since inception is investing in tech startup to build the next insurance generation. So long story short, we have, I would say, a B2B bias. Again, that's based on our network, as we are connected with almost every insurance company across Europe or insurance player across Europe. We have, I believe, an unfair advantage to help our portfolio companies scale faster. So B2b Tech. And then we define, I would say, three topics. So obviously B2B/enterprise software. That's one pillar. The second one is every technology related to existing business lines. So here we broaden a bit the scope with a bit of fintech, a bit of digital health, smart home, mobility. Long story short, existing business line. And then a topic that we love, I would say, is new risks. The rationale behind is that that's where incumbents are not that active yet, and they don't have an unfair advantage because there is no historical data. Like on existing business line. And we put in new risks, weather damages, cybersecurity, personal data, freelancer / gig economy / new way of working, IT-based downtime. That's our last investment that will be announced in the next days. So many topics, crypto, for instance, is around new risk. So long story short, any risk or anywhere where incumbents are not, let's say, fully equipped and where technology could help them cover these kind of risks.
And maybe it's covered. I would have expected embedded insurance or open insurance, because you've been very active from very early on and public about that topic. Is that kind of like a meta layer on top of everything, or have you changed your have you learned something that you might want to share where you say, guys, this embedded thing, it's not going to work out, so by all means, please share.
No, it's working amazingly, I would say. So as you mentioned, we were earlier believer in that trend because we've been mentioning that trend since inception, writing a lot about indirect distribution, believing that platforms are the next insurance distributors. And by the way, we have invested in that space. We have invested in Recover in Spain, which is surging like crazy. They just announced a huge partnership with Fnac, an e-commerce leader in Spain. That's a perfect example of how this trend is growing. And the rationale is that we put it, let's say, at the edge of B2b / enterprise software, because at the end, it's a way to digitize existing players coming from the platform side, though. And it's also covering existing business lines, because most of the products that are delivered there are P&C products, car, home. There is a bit of health, there is a bit of financial with payment protections and so on. So basically, that's a very good question. Where we put embedded insurance, the answer will be at the edge of B2B enterprise software and existing business line, at least in our 3-pillar investment scope.
I just wanted to add a question, because 5 days ago you did a post. Do you know the core difference between open insurance and embedded insurance? Perhaps you could tell something about that.
Yes, that's a very exciting topic. And by the way, a hot topic as well, because we've been discussing that topic like crazy with insurance companies since the beginning of this year. Seems to be the topic for 2021 in insurance. And I would say that first, it's a wording. Insurance companies are talking about open insurance. The market, I mean the platform side, is rather talking about embedded insurance. So that's the first difference. The second difference, though, and again, to be clear, that's the two sides of the same coin. The core difference is that on one side, embedded insurance, you as a tech provider, you are enabling platforms. So your customer is the platform. Hence, you have a very short process to discuss and make it live. And the process works the following way. Platforms are coming to embedded insurance players like Recover. They are saying, okay, I like to embed, I don't know, a smartphone, computer, e-scooter, bike, insurance product. Could you make it happen? Yes, obviously they have the tech layer to embed the product. And then the company is coming to the insurance market saying, okay, here are the products I have ready to be sold. Who is ready to take the risk, or to, let's say, keep the risk? So basically, the insurance company in that word is just the carrier and is at the end of the process. So it's rather coming to the market saying, okay, who is able to take the product tomorrow morning? On the other hand, open insurance is rather to sell SaaS product or tech products or tech solution to insurance companies. So first, the sales process is huge, like in any insurance topic.
Not so bad.
If you crack it, that's huge. But that's the major challenge in open insurance. It's to crack this. But let's say it's 12, 15, maybe 18 months on open insurance. Rather, on the platform side, it's live in 3 weeks. So that's not obviously the same go-to market. But on the other hand, platform takes time, because you need to add on top of each other new platforms to have new distribution channels, and each platform obviously takes a bit of time to grow, so that customer know that the product exists, start to be clear and confident that they can purchase the product online. On the other hand, when you sign with an insurance company upfront, you have significant revenues as a SaaS company. So it's two different business models. And again, I think that to answer your initial question on the core difference, I would say it's the sales process. 3 weeks on one side, more than 12 months on the other one.
I have two follow-on questions, because it was interesting. I actually, I think that's one of the key things is when you go into a conversation and you use certain terminology, make sure you're talking about the same thing. Yeah. Because if I hear open insurance, from the conversations that I've had, it was kind of derived from open banking and about providing access of, you know, transactional risk data on top of it. And then you have the Berlin group, you have different groups. And I found the case for open insurance versus PSD2 or open banking in terms of providing access to these products, providing, you know, is much less so. The way you've described it, absolutely get it, right? You flip it on you enable the insurer from a technology point of view, or you basically do B2B2C distribution and then place the business. But did you feel that open insurance, as by the definition that I've gleaned from market, what do you think about that? I don't know, Tom, was that a little bit where you were going as well with open insurance and embedded insurance, or was this something else?
No, it's just like the discussion we just have at the moment, because I also refer to the post Florian wrote, and we already did quite some podcast interviews on this topic. So for listeners who are interested in that, there are Simon Turren's podcast on embedded insurance. We had Cover, etc. And you see that you have on the one hand the whole discussion, but you also have, especially what we find interesting, Florian, is that in the banking industry, if you just take ING as an example, where they started to open up, now you have from a different point of view, corporation of Cover and Revolut and this kind of things, or Autonova with Get Safe, etc. And then they start to experiment. But if especially these fintech or insurtech companies start to cooperate, then you have a totally different new space.
Yeah, definitely. But I believe that, and to make the link between your two feedbacks, I would say, obviously, open insurance, the word itself is coming from the open banking, and I think that it's why mainly corporates are using that wording, because obviously they have seen what happened in the banking space, that the regulator obliged banks to open themselves, and then they just fear that this will happen in insurance. But our answer and what we see is that we don't need regulation right now to have this kind of let's say open insurance / embedded insurance happen. It's already happening at scale. You mentioned Cover with Revolut. I mentioned earlier WeCover with Fnac. Today I saw that in France, Insurance based in Switzerland is partnering with Back Market, a huge second-hand smartphone and IT devices platform for this kind of embedded insurance product. So basically, I hear the point from corporate saying, okay, the regulation might happen, how should we react, and so on. That's obvious. But the truth is that it's already happening very fast on the market, meaning that I believe that the challenge right now is not whether and when a potential regulation will happen. The question is for corporate, are you ready to answer tomorrow morning if a platform comes to you through an embedded insurtech to let's say carry the product that they are offering? That's the major challenge. And the answer, unfortunately, for most of the market right now is no. But that's what is exciting on my standpoint, and for entrepreneurs as well, is that it's almost D0 for open insurance / embedded insurance on the insurance side. So everything is to be built. Obviously, there are a few players that are already quite advanced. I think about Wacom in France. I think about Baloise in the German-speaking region. I think, Nico, you are working with them, by the way. So these kind of players are a bit ahead of the market, but I would say that most of the other one are just starting working on this kind of API-based projects. And the regulation, maybe it will happen. But by the way, it raised another question around the data themselves. Because if you have a look at the banks themselves, they had a huge amount of very specific data on their customer, the transaction data. They say a lot about who you are and how you behave. So it makes sense to oblige them to say, okay, these are not your data, these are the customers. So basically, you need to open the door so that external players, third-party players could leverage them. But if you have a look at insurance company, they have only poor data about their customer. Obviously, they have the claim historical data for sure, but about you, who you are, how you behave, what's your level of risk, they don't know that much. So even based on that data challenge, I think that considering there will be a regulation around open insurance is highly questionable. Yeah. That's my standpoint.
And maybe just to your question from an investor point of view, I fully get the point of you go to a platform, you abstract this whole, it's annoying, you don't even know who to talk to, the product people might not be the same people who can issue an API, etc. It's a really painful process, and wrapping it up in an MGA has been historically a very great way for insurers to write innovative, not just business lines, but distribution plays. However, if we see, let's fast forward and let's take Cover and Revolut as an example. Now, we know Revolut is pushing down commissions cost, right? The whole emphasis is removing cost from the equation. Now, the usual MGA commission is 30 to 40%. And then maybe depending on how much they pass on. But what I'm getting at is at scale, especially when you are partnering with large platforms, what is your advice to B2B2C MGAs to remain relevant and not be squeezed out as soon as the platforms have scaled and they're getting a taste of that sweet, sweet recurring insurance revenue?
Yeah, that's a very good question, and let's see what happened. But the truth is that we have two examples here. You take a Cover with Revolut. A few weeks later, we saw Simple Insurance with N26, and the CEO of N26 mentioned it himself. He said, we usually do everything on our own. We even tried this one on our own. The truth is that we need a third party to make it happen. So I believe that at the end of the day, obviously, this big platform could do everything on their own. The truth is always the same. It's exactly the same when you are mentioning, okay, Google can make it. Obviously, they can make, everybody can make everything. The truth is that so far, this kind of player, which are huge, again, Revolut and N26, they are huge. And I guess they have the team to make it happen in insurance on their own. The truth is that they are relying on an external player. I think that the rationale behind is the network is both the technology, it's designed for insurance. So it's not a bank product that you, let's say, cannot pivot or upgrade to make insurance happen. It's insurance at core. So I think it's the first challenge. The second challenge is the flexibility that you get with such players, because you can plug or unplug products every day, and you are not relying on one specific insurance company. If you want, basically, you can have the best product or the best insurance carrier for each topic. You can have, I don't know, insurance 1 on bikes, you can have insurance 2 on payment protection, insurance 3 on computer protection. So long story short, with this kind of plugs, because that's how I see the embedded insurance, it's just a tech layer to connect platform on one side that have their own roadmap, and Revolut is one platform at the end of the day. They have their roadmap, and on top of that, they are just adding a revenue stream. And by the way, the magical behind embedded insurance is that for this platform, it's pure margin. So I hear your point saying that instead of having 70% of the margin, they could have 100%. For sure, but they will have all the cost and the pain. Here, it's pure margin. So you have either 70% margin or maybe 100% of the revenues, but the cost and the pain in front of them. So is that exactly the same? I'm not sure. Plus, it's a way for them to be very flexible. If a product doesn't work, they cut it, they try a new one. So it gives them, I believe, a flexibility that they wouldn't have to do it internally. And at the end of the day, it's pure margin for them.
So, and I think that's a very fair point. My point was less so around can they build it themselves, because people wholeheartedly underestimate that insurance is not just another Netflix subscription. it's much more complex. And do you really want to go down that rabbit hole? But I was more going along the lines of 2 to 3 years in, won't the likes of Wacom or AXA beef up on the big revenue streams with APIs, just predatory pricing, whereby they'll just cut out the middleman and deliver that same level of technology? But you've also given there an answer. I think the whole point about at the end of the day, any middleman needs to do more than one-to-one connections, because otherwise the middleman is being cut out. You need to do one-to-many connection, and that can be by aggregating multiple products from multiple carriers. It can be, we see this in the UK on car purchasing, creating a panel of insurers if you have a market where a lot of is compared, and quite frankly, structuring international programs. But it needs to be that, right? Because otherwise you're not a middleman, and they're not going to pay you indefinitely that high margin.
Yeah, definitely agree. And by the way, that could be another core difference between open banking and open insurance. Open banking, basically, you're coming from the insurance side, you're developing API or online distribution for them, and then you plug to a platform. But at the end of the day, the platform is kind of stuck with one insurance company. So maybe they can have all the best product on every topic, maybe. On the other hand, I believe that that's why we definitely make the difference. And again, there are, in Europe, we spotted close to 25 startups operating in embedded/open insurance. And that the difference is very tiny, because most of the players are working on the two sides. But again, it's not the same. When you developed API for, I don't know, any insurance company, then you go to the platform, and even the insurance company itself, they are competing with this kind of embedded players, which are just a pipeline connecting multiple insurance products. And what you mentioned is the perfect example. Why Revolut went with a cover, at least based on what they announced publicly, cover, it's that day one, they were available worldwide.
And I think, there's others, right? There was this recent post in Asia, where they won a big pitch because of product opening, offering multiple products. And I think the interesting thing, and then we can move into a different topic, what we actually seeing is that insurers are realizing that as well. We're actually having several interesting requests as this market is maturing. One, to suggest to an insurer to also, if required, offer third-party products. So the insurer being, pipelining his own stuff, but effectively MGAing and aggregating other parties' products, because they might not be the best manufacturer of something, but to keep that, think about all the product lines of an internet, pan-European banking operation. It's mind-boggling. No insurance P&L can cost effectively serve that. And the other one is around internationalization. It's especially, there's quite a few, I was quite astonished, could that be a right number? Like 300, 400 French mutuals? Could that be that it was that much?
Yeah, in health, you have a lot of players.
But it's like a lot of French mutuals, and a lot of these players are now, they've incepted the platform business, but as they grow internationally, they're losing them because they cannot do cross-border business. And it's just interesting how that market develops. And thank you so much for that assessment. And I think the simple truth is, right, you need to continue working on it. And as in a growth setting, there's always more to be done, but you need to continue growing with them, right?
Yeah.
I guess one thing to kind of just take a step back on what you're doing with Astorya, right? Because aside from investing in, I believe, like 10 startups, not all of them are public, and returning, hopefully sweet returns to your LPs, you must have a near perfect pattern recognition about trends. I'd say it's much better market insight to see, are there smart teams betting on certain developments? Are there products out? Is there a consulting side to your end? Because let's say if I was an insurance company and I wanted to get into the embedded space or how to innovate products, shouldn't I come to you and say, Florian or Jan, hey, what's on the horizon? And can you make an assessment for me to, let's say, partner or build?
Yes, definitely. So, and by the way, and quite interestingly, so we have our core activity, astorya.vc, investing in startup at seed stage. But the truth is that since inception, first, as a seed investor, we see almost every startup and even any entrepreneurs looking for starting a business in insurance. So even people that are not yet a company are reaching out to us just to share a thought on the markets, what we've seen, lessons learned, do's and don'ts on the market. I think it's highly related to our European footprint and the fact that we've been in that space since 2014 or 2015. So meaning a long time ago. That's the first point. And the second point is that since inception as well, we have developed our own scouting tool. The rationale behind was, in my previous life at AXA Venture, I was using PitchBook, CB Insight, Crunchbase. They are very good, but they are very, very US-centric. And they are very focused on startups that have already raised money, meaning that us at Astorya, we are investing in Europe, in startup at seed stage, meaning they have never raised money. These startups were not in these databases. Hence, we developed our own tool. And right now, we have 30% of our database, which is not on these players. And based on this database that we use for our own scouting, we started seeing an interest from the insurance player for not only investing in the company, because obviously that's the rationale with our investor. Our investors are obviously expecting financial return, but on top of that, and since inception, they are looking for insights of the market and, long story short, strategic return. So we've built astorya.vc as and with this capacity to deliver strategic return on top of financial return. And the more we were engaging with the European market, the more we realized that many players that are not able to invest or that don't want to invest in a fund were interested in this knowledge. Hence, we have since 9 months or something like that, a new kind of activity, but actually it's always the same, just a different branding. It's astorya.io, which is a data / scouting / market watch activity, what you call consulting, and where insurance company on very specific topics, they come to us and say, okay, what could we learn on claim management? With whom should we partner on computer vision for claim automation? Is there any specific diabetes startup I should partner with? Or any kind of this topic? We have the data, we have the knowledge, and that's what we are selling to them. Mm-hmm. But again, I believe it's at the end of the day exactly the same activity, because scouting, it's our core activity as an investor, but that's what feed our understanding of the market. We are discussing with what, 500, 600 new startups per year, purely in insurance. So obviously we learn a lot about what's happening. And on the other hand, discussing and selling things to insurance company help us understand their pain points. So basically after that, when I mentioned our network at the very beginning of the discussion as the unfair advantage to accelerate our portfolio, it's all related to that. The more we speak with insurance companies across Europe, the more we understand their pain point, the better we could be in accelerating our portfolio companies. So, and by the way, everything I mentioned around new risks as a core pillar of our investment thesis, this is related as well with our discussion with insurance company, reinsurance company, because we hear that they were not that able to cover this topic because they lack data or they lack technology, and there is room here for buying solution or partnering with solution instead of buying or developing internally the things. So I definitely think that the two are highly related to each other. On one side, let's say you have everything at astorya.vc, everything about what we see, and it's much more a push because we are pushing content to our investor that could learn from what we see on the market. On the other hand, Astorya.io, the data company, is much more a pull. So people are coming to us on a very specific topic where we have the answer. Or I don't know if we have the answer, but at least we have the most exhaustive view on the European market.
Would that be a fair assessment? It would be something similar that Plug and Play does, you know, you on that scouting piece, or?
Yes, on one side, but the major difference I see is first, we have technology at the core of our business. Again, Astorya.io, there is technology as a layer. Intelligence is on top of the technology itself. The only way to make sure that you see everything in Europe before anybody else is to have technology. That's our all automated scouting tool. So the first difference is that we have technologies at the heart of our two companies, I mean, the investment fund and the data / scouting company. And the second point is that we are doing only insurance. And we have been doing only insurance, meaning that we know very well insurance. We are not working on several topics. Plus our network is only Europe and only insurance. Mm-hmm. So I believe that for these three reasons, we are more powerful. And by the way, most of our customers, they are working time to time with Plug and Play or Techstars of these kind of guys. They are a subscriber of PitchBooks and this kind of US-based databases. What they are looking for when they reach out to us is make sure they see everything in Europe and get a very specific knowledge on insurance.
Mm-hmm.
Yeah, but
sorry, Tom.
I would like to ask or to dive into this idea of innovation. I don't know if you're familiar with the innovation dilemma. Yeah. So on the one hand, you can know what will happen, or you can, let's say, you can ask Florian, can you show me what startups or what people or what developments are in a certain field? But that doesn't mean that you act on that. And that's described in this famous book, Innovation Dilemma. So if you just see what we find interesting, Nick and I, on this whole insurance space, is that you have this whole banking fintech space where you had, let's say, similar developments, because in the end there is not a huge difference between insurance and fintech. And if you just see that in all those banks, there were also a lot of smart people watching innovations, but segment by segment is disrupted. So it has been payments, just to take one of the first examples, and you can add a lot of other examples. What's your impression on the big corporate insurance companies?
Yeah.
Because let's say our idea is that, let's say if for instance Cover and Revolut, just to take an example, if they really are able to scale this without old legacy and with much faster speed on decision making, then insurance space will exactly happen the same which also happened in fintech, in the fintech banking space.
Yeah, that's a very fair question. And by the way, I love that book. I find it both depressing because it was written 25 years ago and still relevant. But I find it very exciting as well because there is room for innovation in it. There is the answer. And the answer is, sorry for the conclusion. If you haven't read the book, but I save you a few hours. Anyway, you should read it anyway. I'm talking to the audience, obviously, if you haven't read it already. But long story short, the path to innovation is quite clear, is either deliver new product to your existing customers, and I believe it's very true in insurance. So if you are doing commercial lines, try to find new risks that you could cover. And offer these kind of products and protections to your existing customers. If you are doing P&C, just add new products to your lines, or try to reach out to new customer segment on your existing products. So again, if you are doing P&C home and you have an old customer base, try to reach to students or I don't know. For car, it could be exactly the same. If you are insuring only a high-end vehicle, try to leverage technology to assess a broader customer segment, which are low-cost vehicle or new segment, electrical vehicle, autonomous car tomorrow morning. So basically, that's what I believe is exciting. And by the way, that's what we are seeing happening right now in insurance company. I'm not saying that they are all moving, but if we take them all one by one, they have a few projects. And again, I think that one usual mistake on the market is to try to revamp everything day one. Yeah. If that's the plan, we know the answer, it will not work. So I believe it's not worth trying. But if you take one part of your customer segment, one part of your product portfolio, then first we have many examples of insurance company working on this kind of project, and we are seeing more and more success in the insurance space. And by the way, that's why we are investing so much in B2B technology, is that we believe that insurance company have strengths, they have skills. What InsurTech should bring them or could bring them is the tech asset. Here we believe there is a gap. And that's why we are investing in that space since inception, saying, okay, and again, we are talking about building the next insurance generation in which we believe insurers will be there, but they will change. So technology will help them, again, either deliver new product on existing customer segment or reach out to new existing customer segment on existing products. So long story short, just take one part of your business if you really like to make things change and do step by step. By the way, that's how startups are developing themselves. They are not doing 1 billion of revenues day one. This is the exponential curve. And that's exactly what we are thinking as an investor. That's exactly what you as an entrepreneur are building. It's this exponential curve. So there is no reason corporates shouldn't act differently. The truth is that if you'd like to revamp everything, it's impossible. And here, back to the innovator dilemma, where there are examples in many topics. But again, I mentioned Wacom or Baloise. These guys have been upgrading step by step their internal processes. I have a few examples in mind here in France with tier one insurance company that are all working on this kind of embedded / open insurance on very specific product, home for student, car on demand, this kind of thing. So obviously it's not that visible, but it's happening. And the last point is how to measure innovation. I think that one major mistake in insurance is to compare stock with flow. insurance companies say, okay, InsurTech doesn't work. Why? Because they have millions of customers and they compare it to 100,000 of new users InsurTech are gathering. But the truth is, if you start comparing flow from corporate to InsurTech, here there is a competition. And the example I usually take in France, for instance, Loco, the biggest B2C InsurTech startup in France, last year, they gained on one product, home insurance, more customer than the top 3 mutual that are multi-product. In terms of new customers, they are competing with insurance companies. So for internal project, I think at corporate, it should be the same comparison. Don't compare internal new project on innovation with the stock. Compare it with the flow and new customers. How many customers are you gaining on this innovation project compared to how many new customers you're gaining with your, let's say, regular business? That's the right way to compare it. And by the way, we are working with a few of these guys. The reason why we accepted working with them is because they had this mindset. They were having a business plan with an exponential curve, meaning that they had understood that for a long period of time, potentially, the figures will be low.
I think that's, and conscious that we're running the risk of running a little bit over, but I would love to dig in because I think that is one of the critical elements here. And I want to kind of 2 things. I think exactly what you've stated, how do you measure success is key. Now, I think it's, and I love this analogy actually of stock versus flow and, but it still then requires some form of what is a customer worth, right? What is that worth? Now I found, because we've been on the other end where it's like, oh, success is if we've shipped something. And the world is full of live products that then don't see the light, don't gain that traction, and then also don't help. They're actually counterintuitive to change because they give this proof point around, see, I told you so. Now, what I found is, I think there is a number out in the market, and I'll use Swiss Re, the valuation of iptiQ, and they valued it at 2 billion with 370 million of premium. So to me, there is a market valuation multiple. It's not the 18x of Lemonade, it's 5x of gross written premium. Over a certain, would that be something where you say, listen, guys, if you want to keep it simple, have a gross written premium multiple that is testament to what public markets value in terms of market value. And that is something that you need to focus on, because otherwise it's around what are my, not even premiums, what's my technical profitability on a first year. And then it's obviously really hard because most insurance executives never grew a business from scratch.
Yeah, no,
always had a flow.
That's a very good question. I believe there are 2 details. First, how much of the premium that you are signing are really what I call digital premium. We see a few players, for instance, here in France, they have huge numbers. Really, they have been on the ground for years. The truth is that most of the premium that they sold were on the paper. I mean, like any broker at the corner of the street. So can you value this kind of handwritten premium as, for, again, a Loco, 100% of their policies are coming through their digital process. So here, it's purely digital, what I call digital premium. So I believe that there is a first question here, how much of your premium are really digital?
And by that, you would mean, let's say you had a platform, let's say we were insuring Deliveroo,
yeah.
And you would say that if we're just insuring if we're just insuring the platform on a B2B policy, like a standalone, that would be not digital premium because there's really not that much going. But if you were to issue individual policies or something,
yes,
that would constitute digital premium.
Yes, again, it's all about the customer journey and at the end, the cost of acquisition.
Mm.
If I mean, when AXA is partnering with Uber, I believe that they are doing it what I call manually. Though again, there could be a PDF, there could be e-signature in the process, but at the end of the day, there is a sales process, a discussion. It's not off the shelf. It's not, let's say, the final customer just subscribing online. So I believe that the major difference is what's the customer journey? Is the customer journey close to what incumbents are doing right now? And then it should be valued at the incumbent multiple. In France, a few months ago, we had Aviva France that was valued 3.2 billion euros. So there is a kind of valuation for this kind of player because we know the number of customers that they have, the type of customer, the type of policies and so on. But that's the usual process, I would say. And for startups that are purely online, where I believe the cost of acquisition and the sales process or the sales journey is smoother, then there is another valuation. So I think it's the first point is how tech is really your GWP. That's the first point. And the second point is, but it's related, it's the growth. At the end of the day, what people are evaluating is the capacity to scale. Obviously, you are putting a price on your company today, but what we are buying as an investor is your capacity to grow. And we believe that in 3 years from now, the company will have grown 10 times. But again, it's related because you don't grow 10 times in 3 years period of time.
Yep.
If you are doing things manually.
But if you were just, let's say, take that point, and if you say, okay, capital markets are clever, then you see the investments in the insurtechs, and it doesn't matter if you take, I even would say B2C, then the market says they will disrupt the big corporates. And if you just would come back to, let's say, Clayton Christensen, I think we have to put it in the show notes. Why would the insurance space be different? Especially because the old insurance corporates, they cover everything. So, and they have big legacy. They are not, let's say, they don't have an international setup. So it's even more difficult than the examples Clayton Christensen takes from the computer industry or energy or steel mills, etc. So I really, my personal opinion is that in the insurance space, exactly the same will happen, which also happened with payments, for instance, in the banking space. And I really don't see at the moment that this, let's say, fear of missing out, so to say, is there. So, and I really don't know why this is the case. And I thought, okay, you speak with all the corporate guys on the one hand who invest in your fund, and on the other hand, you see very, very smart young insurtech entrepreneurs. And I really think, especially the second wave, which will come, they will disrupt those corporates faster than they ever did before.
Yes, I'm always surprised when I hear COMEX level saying insurtech doesn't work, because again, that's not what figure says. So I'm really data driven. I'm an engineer from background, so I have a bias here. I believe in figures. So that's, so I agree. I'm always amazed when I hear such feedbacks. But I believe that there are 3 points. So first, and again, our thesis is that insurance company will stay, they will have to change. And long story short, the way we see the insurance space in, let's say, a few years from now, which is related to how telco are operating right now, by the way, is that at the end of the day, the last job for insurance will be to carry the risk, which is, by the way, the current job of reinsurance companies. Hence,
okay, then I totally agree. Then I totally agree on what you say. If the corporates, let's say, have the role like the reinsurance companies have now, then I would totally agree. But I don't know if the corporates will agree on that role.
But that's a good question. So first, few data points. Munich Re, very active on the insurtech scene since inception. Nico, you mentioned iptiQ from Swiss Re. I think it's a great example. We can take SCOR, very active in the UK with an insurtech startup. Hanover Re, they have even a platform to celebrate insurtech startup, Aquarium or something like that. Sorry for the misspelling. So basically, they are very active, the reinsurance companies. And on the other hand, we have a perfect example, I believe, because that's not what they are saying publicly, but that's what I believe. In France, we have Covea, which is a tier 1 insurance company. They try to bot out SCOR, then Partner Re, who's the next one. So we believe that this move that they are trying to do to move up alongside the value chain is the perfect example that at the end of the day, they believe that the insurance job is to carry risk. So let's consider that this is the future. Again, when will it happen? I don't know. And in the meantime, what is very exciting about insurance, I believe, is that you don't need to own 10% of the market to make a multi-billion-dollar company.
Because huge
the market is huge enough. So
yeah.
When I hear insurtech, B2C insurtech startup or insurtech startup is not working, the truth is that, again, if they take 1% of the market, they could be profitable. And the rationale behind is the second point is that due to new IT system, due to new technologies, their break-even of the B2B or B2C startup is way lower from the corporate. So obviously a corporate see himself or itself saying, okay, I need millions of customers to make my IT budget break even. On a startup level, maybe you need what, 200, 300K customers. And back to what you mentioned, Nico, earlier on hundreds of mutual in France. I will take the example of health insurance. In France, you have plenty mutual that have been on the ground 4 years. And when I say 4 years, 50, 70 years, that have less customers than Alan, insurtech in health, which is on the ground for 4 or 5 years. So there are many players that are still alive, that have been live for years, and they are way smaller. So obviously tier 1 players that have millions of customers are kind of laughing at insurtech. And I cannot disagree. They are very small compared to themselves, but again, be careful with the flow. Let's compare the flow. But on the other hand, there are plenty players that are smaller than a few insurtech players and that have been on the ground for years, and nobody is wondering whether they will still be there in a few years from now. They have been for years. So again, you don't need a huge market share to make a huge business in insurance. That's the magic, and that's why we are exciting about insurance. And due to new IT system, new technologies, you have a break-even which is way lower than any incumbent.
Yeah.
Would you, because just to Tom's point, do you've been on the circuit like myself, for quite a while. Do you feel that there has been a change in terms of FOMO of insurance executives? And by that I mean, not the insurance, there's not AXA as a group, whatever, but individual insurance executives. If I was an insurance executive right now, and I'm 36 as well, so let's say people in their late 30s, 40s, who still have 20 years career ahead of them, who are now graduated to a position of budget, of influence, and the two of us would probably own some form of P&L or be on the verge of it. Seeing everything that's going, Corona, embedded insurance, insurtechs gaining these, market shares, and us actually losing out on RFPs, literally saying, listen, I told you. And then let's face it, even if you have Guidewire installed, I haven't seen a single person said, great, now I can, don't you, the people I'm talking to, there is a real FOMO. There's a kind of saying, it's nuts. I can marshal the resources, and I actually have a playbook because I don't need to get this better than Elan or, Luco or Get Safe. I just need to get it equally. I don't need to be Revolut to make my own neobank, right? Because I can get with 90%. I can get there because I have my existing. I think something has changed last year.
Yes.
I don't know. Do you see something similar, or is it kind of the same? no, you know, it'll blow over.
No, you're perfectly right. And listening to you, I was thinking about what happened obviously last year. I quite funnily, end of 2019, we were hearing from corporates that basically they were less in a POC race. They were more and more saying, okay, we have money, we have time, and we want to focus on a limited number of projects, but where we need to have results. So it was a beginning of shift in the mindset. And obviously what happened last year when the world was closed, long story short, what was, let's say, highlighted as the major competitive edge, meaning the network of agents, they were closed. So the truth is that at the end of the lockdown last year, I remember it's Allianz, I think, in France, they announced a 90 million euros budget to make their agents network embrace technology. And suddenly we realized that in a locked world, physical and brick and mortar shops are not relevant anymore. So technology, which was seen as either a POC race or a must-have, suddenly become a need. And by the way, I mentioned that we launched Astorya.io, our scouting market watch activity in September last year. Here is the rationale. Because we suddenly were reached out by many insurance companies across Europe saying, okay, we need a technology in that space. Could you help us find the right player in that, that position? And it was true alongside all the value chain. So we were, I would say, ahead, maybe too ahead of the market when we launched Astorya, really believing that we could invest again at seed stage in startup that would be mature in 3 to 5 years from our investment. And suddenly there was a huge need and huge appetite from the market. Again, they are not changing everything. They are not interested in every part of the insurtech market, but the truth is that on 1 or 2 projects, most of insurance players across Europe are looking for tech solution. And I would say, unfortunately, it's related to what happened last year and the lockdowns, where again, we realized that technology is a need. And by the way, you mentioned embedded insurance. The proxy I have in mind is the e-commerce level out of the retail market. It grew from 15% to 40, even 50% on several product categories. So you cannot make as if people haven't switched their behaviors.
But it's not a day one approach. I mean, if you just watch Jeff Bezos, or you could also take Andy Grove of Intel, only the paranoid survive. It's the interesting thing that the players who move fast and are extremely aggressive, Amazon wants to buy MGM today, or if you see Mike Zuckerberg, enormously aggressive buying potential competitors, exactly. And on the other hand, you have the big incumbents. And when I watch those people, I always say it's day 7. It's not even day 2. So they are so far away of let's say of this need to go much faster. And Nick always stresses the enormous distribution costs. If you compare this with other, let's say, sectors of industry, if you take retail, etc., where you have your margins of 2 or 5%, you have insurtech or insurance with 30%. This is so obvious. It's such a no-brainer that you can earn an enormous amount of money. And all those big tech players, we even discussed this today. If really the Amazons and the Googles of this world will enter in this space, if we already have seen in Asia, I really think, okay, you really, I'm really thinking if they are aware of it's a kind of tsunami which will be coming, especially in Europe, where they just wake up, guys. You have to really speed up.
Yeah, I think it's the downside of the stock market. The stock market, I mean, insurance is a stock business. Sorry, it's not stock market, a stock business. Obviously, when you are making billions of profits every year, it's not that obvious
that
a startup will take your business or cut your leg, because at the end of the day, it's that if you sum up all the insurtech players, first, as I mentioned earlier, individually, a few of them are directly competing with tier 1 players. But let's take the insurtech market in itself. If you sum up the figures from all these players, it starts to be significant. Sometimes it's on several markets, it could be 1 million customers. 1 million customers start to be something. So obviously it doesn't kill incumbents, but at least it cut their leg. So I think it's the point, and it doesn't cut your leg day one. It's step by step. Yeah, so I believe that's the downside of the stock business. And by the way, that's why I'm so pushy on having the stock compared to flow.
Yeah, sure, you're totally right.
I really believe that again, by design, the stock will decrease. People will die at the end of the game. So whatever happened, or so far, people are dying at the end of the game. So that your stock will decrease by design. So you need to feed it with the flow. Hence, I believe that obviously having a stock is a strength, but before saying insurtech doesn't work, you should definitely have a look at the flow. And again, there are plenty of incumbents that have a flow of new customers that is way bigger than even the tier one insurtech. So I'm not saying that everybody should be frightened, but again, the market is so diverse. You have huge players, international players with millions of customers. Are they at risk? Maybe not tomorrow morning, maybe one day, or maybe never. But there are not only AXA Alliance guys, there are also a smaller player on the ground. And maybe this one are more at risk. And by the way, last point, maybe it's what we see on the M&A market. M&A is a kind of disappearance for a brand. Usually, by the way, when insurance companies are merging together, usually the brands disappear and the new brand appear.
That's right.
So maybe as a kind of last statement, or maybe piece of advice, if you were tasked with, the CEO or the person in charge of generating flow for an insurance company, and let's assume for the sake of it, it's not AXA or Allianz, right? Let's assume it's a company. Let's assume it's a mutual even. So let's assume it is entrepreneurial. It doesn't want to have short-term results. So let's move that out. What would you do? What do you think? What would be your first 100 days, or what would you change, in order to generate flow, knowing what you know right now?
Again, back to the innovator dilemma. I would kick off a team which is located outside of the headquarters, which has its own budget, validated on a BP on a business plan where year one, you sell one policy, not zero, one. One means it's live, it works. But one, meaning there is no expectation in terms of figures. And third point, with a new brand. With these three topics, you can start really something. And then I would leverage on one existing product and try to reach out to a new customer segment. So take your core business. And again, it's just a way to build the new IT system from scratch. You will test it on a new customer base, meaning that there is no internal competition. Nobody will come to you say, okay, you're taking my business, yeah, that's right. You should stop. So here, no competition. You leverage the insurance skills because it's an existing product. So you can go to business lines and say, okay, can you explain me how you price it? What's the core topic to assess the price and to underwrite or to manage the claim for this kind of project? So you have the skills and you have the knowledge internally because this is an existing product. Just you are reaching to new customer segment where technology helps you, again, decrease the cost, decrease the risk, and decrease the pain. But again, first thing first, it should be outside as much as possible.
You just described what Clayton Christensen as only a recipe says and also explains in his book.
But it
I think Florian following. No, sorry, go ahead.
No, we are working with a few insurance companies that have this kind of setup, and it's working right now. It's not working because we are working with them. It's working because they have this setup. And that's why I mentioned it's both depressing and exciting. The book, The Innovator Dilemma, depressing because written 25 years ago and still relevant, but exciting because there is the receipt. And the receipt I mentioned before, it's not my receipt, it's the receipt from the book. That's what we are seeing at a few corporates. And by the way, the corporates that are issuing this kind of project, it's working. By the way, back to what you mentioned on iptq. iptq doesn't sound like Swiss Re, even the name. So I believe that
they did on
public
purpose,
example of a team. I guess they are in the same building as the Swiss Re team, but anyway, the brand iptq has nothing to do with Swiss Re. So I believe, and we will see many and many examples in the future. If you take, for instance, Société Générale, a bank insurance in France, they have an insurtech startup. The name is Moonshot Internet. There is nowhere Société Générale. And okay, the team is in the same building.
Yeah, see what happens.
The brand is the same.
But the interesting thing is iptq and also Munich Re, the ones, to our point of view, who did probably best or moved first were the reinsurance companies, because they had the fear of being disrupted by the insurance companies, which is also interesting.
Yeah, I think that we will.
But that's another topic.
No, but we will have an increasing competition here, I believe.
Nick always says conscious of time.
Yeah, conscious. I mean, I think this was the longest one, but Florian, sorry, I think I think we went down exactly the right rabbit hole, right? And I think this was, quite frankly, refreshingly candid, and not it depends, but outside organization, year one had one life policy, because you cannot sell a fake product.
Exactly.
New brand, focus on one customer segment, and I think that's really sound and really clear advice. And basically have this as a self-contained entity. And if they manage to procure the right product from headquarters, great. If they get it from someone else, great. If they manage to cross-sell into existing relationships, I'm sure that some iptq relationships are introduced by their client managers, but they're also not waiting for them and going there. And I think it's that plurality, but independence, because you need to remove excuses. Right? I mean, as you're probably, when you're sitting on the board, the founders need kind of say, well, I was waiting for them, and you're like, well, okay, that's fair enough, but what's plan B or plan C? Get moving. Awesome. I mean, this was so great, and thank you so much for that insight. I don't know, gentlemen, any last words before we wrap up for today?
After COVID, we'll meet in Paris on a terrace and continue our discussion. The nice thing is that Zurich is is one of the few very fast connections. So looking forward to continue our talks. I'm really one last remark. I often have the impression that the insurtech entrepreneurs, they have read books like Clayton Christensen, Innovator's Dilemma, and if you confront people who are in those corporates, they just often they haven't even read the stuff. But I don't know if in France if it's different. But
no, it's always the same. That's why it's my last slide usually in any presentation, just saying, okay, don't forget to read it. I mean, beyond quoting it in Twitter or LinkedIn, but reading it for real. And maybe last word, thanks a lot to you for that discussion. Very enthusiastic. Looking forward to having the follow-up in real life. And by the way, the conclusion is that there is so much to be built in insurance. That's incredible. Really exciting, either on the insurtech scene or on the incumbent scene as well. And I really believe, hence, again, our job as an investor, we strongly believe that there is a match here between technology on one side and business knowledge and business skills on the other side. So really excited about the near future in insurance and insurtech.
Thank you.
Likewise. Florian, Tom, thank you so much for your time. It was a pleasure, and see you on the circuit. Take care. Bye.